Welcome to today's live Forex trading session. I'm here to walk you through the reality of currency trading, the good, the challenging, and everything in between. What is live Forex trading? Simply put, it's buying and selling currencies in real time as market conditions change. Think of it like exchanging money at the airport, but instead of just swapping dollars for euros for vacation, you're doing it to profit from price movements. The foreign exchange market is the largest financial market globally, operating around the clock. Unlike stocks that close at specific times, currencies never sleep. When London closes, Tokyo opens, and when Tokyo closes, New York is getting started. Why try live trading? Many traders start with demo accounts, which use fake money to practice. While demos are valuable for learning, live trading with real money brings psychological pressure that changes everything. Your heart beats faster, your palms sweat, and suddenly those easy trades become much more complex. Today I'll share what happens during actual live trading sessions. The strategies, the emotions, the wins, and the losses. This isn't about showing off profits or selling you a course. It's about honest education for anyone curious about Forex trading. What you'll learn today: real trading strategies in action. Common emotional traps traders face. How to manage risk effectively. What actually happens when trades go wrong. Practical lessons from live market conditions. Remember, trading involves substantial risk. Never trade money you can't afford to lose, and always do your research before making any financial decisions. Let me be honest about the challenges every Forex trader faces, because understanding these obstacles is crucial before you even consider placing your first trade. Challenge 1. Market volatility. Currency markets can move violently within seconds. Economic news, political events, or even rumors can send exchange rates soaring or plummeting. Imagine you're trading euros against dollars, and suddenly the European Central Bank announces an unexpected interest rate change. Your calm, calculated trade can instantly become a losing position. For example, during major economic announcements, currency pairs can move hundreds of pips in minutes. A pip is the smallest price movement in Forex, typically the fourth decimal place. If you're trading with leverage, these small movements translate into significant profits or losses. Challenge 2. Emotional decision-making. This is perhaps the biggest challenge. When real money is on the line, logic often goes out the window. You might plan to risk only small amounts, but after a loss, you're tempted to double down to recover quickly. This emotional trading destroys more accounts than any technical strategy ever could. Fear and greed dominate trading decisions. Fear makes you close winning trades too early, while greed keeps you in losing trades too long, hoping for a miraculous turnaround. Both emotions are natural, but they're also your worst enemies in trading. Challenge 3. Information overload. Modern trading platforms provide endless charts, indicators, and analysis tools. New traders often think more information equals better decisions, but the opposite is usually true. You can spend hours analyzing moving averages, support and resistance levels, and trend patterns, only to be paralyzed when it's time to actually trade. The price breakout strategy revolves around spotting price breakouts, which can signal the start of a new trend. But recognizing these patterns in real time while managing emotions is incredibly difficult. Challenge 4. Timing the market. Forex markets operate across multiple time zones, and what works during European trading hours might fail during Asian sessions. Currency pairs behave differently at various times, and understanding these patterns takes considerable experience. Challenge 5. Risk management. Most beginners focus on finding winning trades, but ignore position sizing and risk management. You might win 8 out of 10 trades, but if those 2 losses are larger than your 8 wins combined, you're still losing money overall. These challenges aren't meant to discourage you. They're realities every successful trader has learned to navigate. The key is understanding them before you start, not discovering them after you've lost your first trading account. Now let's dive into what actually happens during a live trading session. I'll walk you through the strategies, the decision-making process, and the real-time challenges that arise. Pre-market analysis. Before placing any trades, I start with market analysis. This isn't about predicting the future. It's about understanding current market conditions and identifying potential opportunities. First, I check the economic calendar for major announcements. Central bank decisions, employment reports, and inflation data can dramatically impact currency values. If the Federal Reserve is announcing interest rate decisions, I know dollar pairs will likely be volatile. Next, I analyze the charts. I look for key support and resistance levels, price points where currencies have historically bounced up or down. These levels act like psychological barriers that traders watch closely. Strategy selection. For beginners, the best Forex trading strategies in 2025 are trend following or range trading. Today, I'm using a trend following approach, which means I'm looking to trade in the direction of established market momentum. The strategy is straightforward. Identify a clear trend. Wait for a pullback to a support level, then enter in the direction of the trend. For example, if the dollar has been strengthening against the euro for several days, I wait for a temporary dip before buying dollars. Risk management setup. Before entering any trade, I calculate exactly how much I'm willing to lose. This isn't pessimistic thinking, it's professional risk management. I use stop-loss orders, which automatically close positions if they move against me by a predetermined amount. My rule is simple. Never risk more than 2% of my account on any single trade. If I have a $1,000 account, I won't risk more than $20 per trade. This might seem conservative, but it ensures I can survive multiple losing trades without devastating my account. Live trade execution. The moment of truth arrives when I place the trade. Despite all the analysis and planning, there's still nervousness. Real money is now at stake, and the market doesn't care about my analysis. I place a buy order on the dollar against the yen based on the trend analysis. The entry point is at a support level that is held multiple times over the past week. My stop loss is set just below this support level, limiting my risk to $15. Monitoring and adjustment. Once the trade is live, the real work begins. I monitor the position constantly, watching for signs that my analysis might be wrong. The market is a dynamic environment. What looked like a strong trend can quickly reverse. During the first hour, the trade moves in my favor. The dollar strengthens against the yen, and I'm showing a small profit. However, I resist the urge to close the position immediately. Premature profit-taking is a common mistake that limits long-term success. The psychology of live trading. What's striking about live trading is how different it feels from demo trading. With fake money, I was calm and rational. With real money, every small price movement creates an emotional response. When the trade briefly moves against me, I feel the urge to close it immediately, even though it's within my planned risk parameters. This is where discipline becomes crucial. I stick to my original plan, keeping the stop-loss in place and allowing the trade room to develop. Professional trading isn't about being right all the time. It's about following a consistent process, adapting to market conditions. Midway through the session, economic news breaks that affects my trade. The Bank of Japan hints at potential interest rate changes, causing increased volatility in yen pairs. My carefully planned trade now faces unexpected market conditions. This is where experience matters. Rather than panic, I reassess the situation. The fundamental analysis still supports my position, but the increased volatility means I need to be more cautious. I consider tightening my stop-loss to protect profits, but ultimately decide to stick with the original plan. Multiple trade management. As the session progresses, I identify another opportunity in the euro-dollar pair. Now I'm managing multiple positions simultaneously, each with different risk profiles and time horizons. This requires constant attention and emotional discipline. The key is treating each trade independently. The profit from the first trade doesn't influence my decisions on the second. Each position has its own risk management parameters and exit strategy. The pivotal moment of this trading session came when both of my positions simultaneously faced significant pressure. What started as a routine trading day quickly became a lesson in crisis management and the importance of staying calm under pressure. The market shock. Approximately 3 hours into the session, unexpected news hit the markets. A major central bank made surprise comments about future monetary policy, causing instant volatility across all currency pairs. Within minutes, both of my positions were showing significant losses. My dollar-yen trade, which had been profitable, suddenly reversed as the yen strengthened rapidly. The euro-dollar position, which I had entered based on technical analysis, also moved against me as the dollar weakened across the board, the critical decision. This is where live trading becomes a psychological battle. My computer screen showed red numbers, both positions were losing money. The natural emotional response is panic. Close everything immediately to stop the bleeding. But here's what separates experienced traders from beginners. I had planned for this scenario. My stop-loss orders were strategically placed, and I had calculated exactly how much I was willing to lose before entering the trades. The losses, while painful, were within my predetermined risk parameters. The temptation to overtrade. As the losses mounted, I felt the overwhelming urge to fix the situation by opening new positions. This is called revenge trading. Trying to quickly recover losses by taking bigger risks. It's one of the fastest ways to destroy a trading account. Instead, I forced myself to step away from the computer for 10 minutes. This cooling-off period allowed me to reassess the situation objectively rather than emotionally. When I returned, I could think clearly about my next moves. The unexpected turnaround. Sometimes the market rewards patience. About an hour after the initial shock, clearer information emerged about the central bank's actual intentions. The initial market reaction had been an overreaction, and prices began to normalize. My dollar-yen position, which I had resisted closing despite the temporary losses, began to recover. The technical support level that formed the basis of my original analysis held firm, and the trade eventually became profitable again. However, the euro-dollar position remained problematic. The fundamental factors that had initially supported this trade had genuinely changed, and I made the decision to close it for a planned loss. The lesson learned. This experience reinforced a crucial trading principle. You can't control the market, but you can control your response to it. The difference between successful and unsuccessful traders isn't the ability to predict market movements. It's the discipline to stick to a plan when emotions run high. The key moment wasn't the initial market shock or the eventual recovery. It was the decision to trust my risk management system and resist the emotional impulse to abandon my strategy when faced with temporary losses. After 6 hours of live trading, here are the key takeaways that every aspiring Forex trader should understand. What worked? Risk management saved the day. By calculating position sizes carefully and using stop losses, I limited potential damage during volatile market conditions. The losses I experienced were painful but manageable, allowing me to continue trading rather than wiping out my account. Sticking to the trading plan proved crucial. Despite emotional pressure to close positions or open revenge trades, following the predetermined strategy ultimately led to better outcomes than emotional decision-making would have. Technical analysis provided a solid foundation. The support and resistance levels I identified before trading actually held when tested by market volatility, validating the importance of proper chart analysis. What didn't work? Overconfidence in fundamental analysis led to problems. I placed too much weight on economic indicators and didn't adequately consider how quickly market sentiment can change based on news and rumors. Insufficient consideration of correlation between currency pairs caused issues. When I opened positions in both dollar-yen and euro-dollar, I didn't fully account for how a broad dollar movement would affect both trades simultaneously. How this changed my perspective. Live trading is fundamentally different from demo trading. The psychological pressure of real money creates challenges that can't be simulated with fake accounts. By starting small, choosing a reliable broker, and applying solid strategies like risk management and market analysis, beginners can build their confidence and work toward long-term success. The importance of emotional discipline cannot be overstated. Technical knowledge and market analysis are important, but the ability to control emotions and stick to a plan determines long-term success in Forex trading. Final thoughts. Forex trading isn't a get-rich-quick scheme. It's a skill that requires continuous learning, practice, and emotional development. Successful trading is usually built up through years of experience and discipline. The market will always be there tomorrow. There's no need to risk everything on a single trade or trading session. Patience, consistency, and proper risk management are far more valuable than any secret strategy or indicator. Remember, this is just one trader's experience during one session. Every trader's journey is different, and what works for one person may not work for another. The key is to find an approach that suits your personality, risk tolerance, and lifestyle. Now I want to hear from you. In the comments below, share your own Forex trading experiences. Are you just starting out, or have you been trading for a while? What challenges have you faced, and what lessons have you learned? If you're new to Forex trading, don't start with real money. Begin with a demo account. Practice these risk management principles, and take time to understand your emotional responses to winning and losing trades. Subscribe to this channel for more honest educational content about Forex trading. Hit the notification bell so you don't miss future live trading sessions and strategy breakdowns. Check out this video. I tried day trading and this happened. The link is in the description and the info card on top. Join our community of traders who are committed to learning and improving together. Trading doesn't have to be a lonely journey. Share your experiences, learn from others, and grow as a trader. Remember, never trade money you can't afford to lose. Always do your own research, and consider consulting with financial professionals before making investment decisions. Thanks for watching, and I'll see you in the next video.